Welcome to the Deep Dive. Today, we're going to be tackling quantitative trading.
Oh, exciting.
And using Lars Kestner's Quantitative Trading Strategies as our roadmap.
Yeah.
You know, you've been really curious about how these strategies are actually developed. You know, how are they tested? How are they used to gain an edge in the market?
Yeah. It's a big question.
It is a big question, so
Lots to unpack.
buckle up. It's going to be a fascinating journey.
Absolutely. We're going to be really delving into the history of it, how quantitative trading has evolved and why it's become such a powerful force in the markets. And we'll look at how it stacks up against those traditional methods like fundamental analysis.
Yeah, right. Okay, well, before we get ahead of ourselves, let's start with the basics.
Sure.
How does Kestner define quantitative trading?
Well, he defines it as a really systematic approach
Okay.
that blends technical and statistical analysis to generate those buy and sell signals. So instead of relying on intuition or gut feelings, it's about letting the data guide your decisions.
So it's like taking the emotion out of trading.
Yes.
Which I can imagine is pretty appealing to a lot of people.
It can be, for sure.
But does that really work?
Well, that's where backtesting comes in.
Okay.
It's a crucial step where you test your strategies against historical data to see how they would have performed.
Okay.
Now, it's not a crystal ball or anything like that.
Right.
But it helps you gain confidence in your approach.
So you're not just blindly trusting a formula, you're checking if it actually has legs, so to speak.
Yeah.
Now, you mentioned data-driven decisions, but doesn't the efficient markets hypothesis kind of contradict that? Doesn't that theory say that it's impossible to consistently beat the market?
Right. The EMH, it's a cornerstone of finance, suggesting that markets instantly incorporate all information into prices.
Oh.
So in a perfectly efficient market, every opportunity would be priced in, leaving no room for consistent outperformance.
But Kestner seems to poke some holes in that theory, right?
He does.
He presents some arguments and studies that challenge the idea that markets are always perfectly efficient.
Exactly. He highlights research that shows certain strategies have consistently generated profits over time.
Okay.
Which suggests that maybe the EMH isn't the whole story.
Interesting.
For instance, one study he cites analyzed 1,400 of the largest stocks and found that portfolios built from underperforming stocks actually went on to outperform in subsequent years.
Wow.
It really makes you question things, doesn't it?
That is a bit of a head-scratcher. He also talks about technical analysis, and I was really intrigued by the visuals he includes, things like double top and head and shoulders patterns.
Plastic patterns.
Yeah, so you're saying these patterns, which technical analysts have used for ages, actually have some predictive power.
What's fascinating is that these patterns shouldn't exist if markets were truly efficient.
Right.
Their very presence suggests there's something else at play, something beyond just instant information absorption.
And that something else is probably human psychology, right?
Yeah, likely.
Kestner brings up behavioral finance and how our emotions and biases can create inefficiencies in the market. It's kind of like the market is this giant psychology experiment sometimes.
Oh, for sure.
With everyone overreacting.
Exactly. If humans were perfectly rational, quantitative trading would be much less effective.
Right.
But, as we all know, humans are anything but perfectly rational.
Yeah, definitely.
And those irrationalities can create opportunities for those who know how to spot them.
It reminds me of that classic experiment by Kahneman and Tversky where they showed how framing influences decision-making.
Oh, yeah. That's a good one.
They asked doctors to choose between different treatment options.
Right.
And even though the outcomes were identical, the way the options were framed significantly influenced their choices.
Crazy, right?
Yeah.
It's a fantastic example of framing bias.
Yeah.
And the same principle plays out in the markets all the time. Think about market bubbles and panics.
Yeah.
These are prime examples of how emotions and biases can drive prices far beyond what fundamentals would suggest.
Kestner also references Robert Shiller's work on market volatility. Shiller found that stock prices swing much more wildly than the underlying fundamentals of companies would justify.
Yeah, that's excess volatility for you.
Yeah, that points pretty clearly to the influence of human behavior, doesn't it?
Absolutely. Shiller argued that investor psychology And our tendency to overreact is a key driver of that excess volatility, creating opportunities for those who can remain level-headed amidst the chaos.
So knowing that we humans leave these behavioral fingerprints all over the market, how can quantitative traders actually exploit those patterns?
Wow.
Kessner talks about trend-following strategies.
Yes.
But is it really that simple? Just ride the trend.
Well, trend-following strategies are based on the idea that markets tend to move in trends, and these trends can persist for longer than many people expect.
Okay.
So they aim to capitalize on our tendency to sell winners too early and hold on to losers for too long,
Right.
hoping they'll turn around.
It's that classic fear of missing out, or FOMO.
Oh, yeah.
Driving us to buy high and sell low, right?
Right.
It's almost like our instincts are often working against us.
It really can seem that way sometimes.
Kessner mentions Richard Dantian, a well-known commodities trader.
Yeah, I know him.
Who actually missed out on some massive rallies.
Wow.
Because he was so convinced the market was going to go down.
He was bearish.
Yeah, he had this system that generated buy signals, but his bearish bias kept him from following it.
Oh, that's gotta hurt. It just goes to show that even the most experienced investors can fall prey to their own biases.
Right.
A systematic quantitative approach can help you detach from those emotional impulses and stick to a plan,
Right.
which in the long run can be really valuable.
So if emotions can lead us astray, does that mean fundamental analysis is no longer relevant?
Well,
Is it all about algorithms now?
Kessner acknowledges the value of fundamental analysis,
Okay.
but he also highlights its limitations. He brings up a fascinating idea. Prices move first, and fundamentals follow.
Interesting.
You see, it suggests that market sentiment, driven by those very behavioral factors we discussed,
Right.
can drive prices in the short term, even if the underlying fundamentals haven't caught up yet.
I'm thinking about those examples he uses. General Motors, Amazon, Cisco, showing how their stock prices experience huge swings, even when their earnings were stable, or even rising.
Yeah, it's a good reminder that the market doesn't always behave the way we expect it to.
So if we can't always trust fundamentals, and our emotions can cloud our judgment,
Right.
how do we manage risk in this wild world of quantitative trading? I mean, it sounds a bit like the Wild West out there.
Well, Kessner emphasizes the power of diversification,
Okay.
and he draws on Harry Markowitz's portfolio theory to explain why it's so important.
Yeah.
Think of it like spreading your bets at a casino.
Okay, so instead of putting all your eggs in one basket, you're spreading them out across multiple baskets to reduce the risk of a complete wipeout.
It's kind of like the casino itself.
Right.
They thrive on the law of averages.
Yeah.
Kessner analyzed a moving average crossover strategy across 9 different futures markets and found that a diversified portfolio significantly outperforms any individual market.
Okay.
He even provides a table of results in the book
Wow.
that shows just how powerful diversification can be.
He also describes how the portfolio's equity curve,
Right.
that line that shows your profits and losses over time, is much smoother than any individual market.
Smooth is usually better when it comes to returns.
Right. That smooth curve is pretty appealing,
I agree.
especially if you're someone who doesn't like those big swings.
Yeah, less stress.
Speaking of measuring performance, Kessner introduces 2 key metrics,
Okay.
the Sharpe ratio and the K ratio.
Those are the big ones.
Yeah, I've heard of the Sharpe ratio. It measures risk-adjusted returns, right?
Exactly.
So it's not just about how much money you make.
Right.
It's about how much risk you're taking to make it.
Yeah, it tells you how much return you're getting for each unit of risk you're taking.
Okay.
And Kessner gives us a useful benchmark. Look for strategies with Sharpe ratios above 1. That gives you a tangible target to aim for.
And what about the K ratio? How does that one work?
So the K ratio, it complements the Sharpe ratio by looking at the consistency of returns over time.
So it's like evaluating how smooth that equity curve is.
Exactly, yeah. Kessner suggests looking for K ratios above 0.5 as a good indicator of a consistently performing strategy.
Okay, so we've got our winning strategies.
Right.
We've diversified our portfolio, and we're using these ratios to keep things in check.
Yes.
But Kessner also talks about optimizing strategies, right?
Yeah.
Is that where the real magic happens?
Well, optimizing your strategy's parameters can be very tempting.
Yeah.
But it comes with a major caveat.
Okay.
Beware of curve fitting.
Curve fitting, that sounds a bit ominous.
It can be.
What exactly is it?
It's when you over-optimize a strategy to perfectly fit historical data.
Okay.
You might think you found the holy grail, but it often falls apart when you try to use it in real-time trading.
I see.
It's because you've essentially tailored it to the past,
Right.
not the future.
So like a race car that's perfectly tuned for one specific track,
Yeah.
but then it sputters and stalls on any other course.
It's a great analogy.
So, okay, so you can't just force a strategy to work everywhere.
Yeah.
So we've covered a lot of ground.
We have.
Developing strategies, managing risk, avoiding those optimization pitfalls.
Right.
But what about money management?
Ah, yes. Money management.
How do we determine how much to risk on each trade?
Money management.
Yeah.
Often overlooked,
Right.
but absolutely crucial aspect of trading.
Yeah.
Even with a fantastic strategy, poor money management can lead to ruin.
Wow.
Kessner compares it to a poker player going all in on one hand.
No matter how good your hand is,
Right.
if you lose it all in one go, game over.
Right.
Okay.
Okay. Kessner talks about the concept of optimal leverage, how much you should borrow to amplify your returns.
Right.
He stresses that it depends on the strategist's risk-reward profile.
Okay.
It's a delicate balancing act,
Yeah.
finding that sweet spot between maximizing returns and avoiding catastrophic losses.
That's a great point to stop for now.
Okay.
We've covered a lot of ground
Yeah.
from challenging the efficient markets hypothesis to understanding the role of psychology in trading. And we've even gotten a taste of some key strategies and risk management techniques.
Yeah, we've laid the groundwork.
Yeah.
And this is just the beginning.
Okay.
In the next part, we'll delve deeper into specific quantitative strategies
Okay.
and see how they work in practice.
I'm ready to put these concepts into action. Me too.
Okay.
All right.
Do it.
Welcome back to the deep dive. We're diving deeper into quantitative trading strategies based on Lars Kessner's book, Quantitative Trading Strategies. In the last part, we talked about the big picture, the whys and the hows of quantitative trading.
Oh, right, the fundamentals.
Yeah, but now I'm ready to kind of get my hands dirty
Okay.
and see some actual strategies in action.
I hear you. It's time to put those concepts to work.
Yeah.
Kessner outlines a variety of really fascinating strategies. Where should we start?
Okay.
How about the channel breakout strategy?
Okay.
It's a classic trend-following approach that's been around for a while, but it's still very relevant today.
Trend following.
Yeah.
That makes sense. We talked about how humans tend to be bad at recognizing trends. So
Right.
maybe that's where a systematic approach can really shine.
It can.
But how does this channel breakout strategy actually work?
So picture a price chart.
Okay.
A channel breakout strategy identifies those moments when the price breaks out of a defined range,
Okay.
signaling a potential shift in momentum.
So it's like the price is stuck in a channel, moving between some upper and lower boundaries,
Yes.
and then, boom, it breaks free, and that's our signal.
Exactly. Let's say you're looking at a stock's price
Mm-hmm.
over the past 40 days.
Okay.
The highest and lowest prices during that period
Yeah.
form the boundaries of your channel.
Okay.
If the price breaks above the highest point, it's a buy signal.
Mm-hmm.
If it drops below the lowest point, it's a sell signal.
I like that it's visual. You can literally see it happening on a chart. So you're betting that once the price breaks out of that range,
Yes.
it's going to keep moving in that direction.
You're essentially riding the wave
Okay.
of the breakout momentum, hoping that it'll carry you further.
Okay.
Kessner actually illustrates this with a chart of American International Group, or AIG,
Right.
stock in his book.
Okay.
You can see how the price breaks out of the channel and generates those buy and sell signals.
Okay.
It's a nice way to connect the concept with a real-world example.
That's really helpful, seeing it in action.
Yeah.
But what about when the market isn't trending?
Right.
What if it's just bouncing back and forth without a clear direction?
Yeah, those choppy markets.
Yeah. Are there strategies for those?
Absolutely.
Okay.
Kessner introduces some really interesting oscillator-based strategies that can thrive in those sideways markets. One that caught my eye is the MACD histogram retracement system.
Okay. MACD, that rings a bell.
The popular one?
Isn't that a popular indicator used in technical analysis?
Yes. MACD stands for Moving Average Convergence Divergence.
Okay.
It's calculated by taking the difference between two moving averages of the price, a faster one and a slower one.
Okay.
And the histogram is a visual representation of that difference, making it easy to see shifts in momentum.
So where does the retracement part come in?
Right.
Is it about buying the dips?
It's about buying the dips within the context of the MACD indicator.
Okay.
So the strategy looks for moments when the MACD histogram retraces a certain percentage of its previous extreme move. For example, let's say the histogram has been trending down.
Okay.
And then starts to bounce back up.
Right.
This strategy would generate a buy signal when that bounce reaches a specific percentage, say 25% of the previous downward move.
So you're not trying to time the absolute bottom.
Right.
You're just looking for signs that the momentum is shifting in your favor.
Exactly. And Kestner's backtests show that this strategy actually performs pretty well.
Okay.
For example, in futures markets,
right.
It generated a Sharpe ratio of 1.59 and a K ratio of 0.55.
Those are solid numbers.
They are.
He also includes a visual of the strategy applied to the coffee futures market, right?
He does. You can see how it captures some nice swings,
Okay.
both up and down, by responding to those shifts in momentum,
Okay.
as indicated by the MACD histogram.
Now, Kestner also points out that this strategy can be further optimized by adjusting the retracement percentage and the thresholds for entering trades.
Yes, but he always cautions against curve fitting, of course.
Right. We don't want to get too carried away with optimization and end up with a strategy that only works on historical data.
Exactly.
Speaking of capturing swings, Kestner also talks about a strategy called the divergence index.
Yes. That's a good one.
Which sounds really interesting.
It is. Yeah. The divergence index is a fascinating one. It aims to take advantage of the difference in momentum between two different time frames.
Okay.
So it uses two moving averages of momentum, one short term and one long term.
Right.
And it calculates the difference between them.
So it's like comparing the short-term mood of the market with the long-term trend, looking for those moments when they start to disagree.
Right. You got it.
So would you say it's kind of an early warning system for potential trend changes?
That's a great way to put it.
Okay.
It's about identifying those subtle shifts in momentum that might foreshadow a bigger reversal.
So how do you actually translate that divergence into trading signals?
So the strategy involves setting thresholds for the divergence index.
Right.
For example, you might enter a long position when the index falls below a certain negative value, indicating that the short-term momentum is significantly weaker than the long-term trend.
Interesting.
Conversely, you'd enter a short position when the index rises above a certain positive value,
signaling short-term strength, diverging from long-term weakness.
So you're looking for those moments when the short-term momentum is hinting at a change in the tide, so to speak.
Exactly.
Did Kestner's tests show this strategy to be effective?
Yes. The divergence index performed quite well, particularly in the futures markets. It achieved a Sharpe ratio of 1.24.
Wow.
And a K ratio of 0.51. Suggesting a good balance of risk and reward.
Yeah.
Kestner even provides an example of the strategy applied to Philip Morris stock. Showing how it successfully caught a pullback in a longer-term uptrend.
It's amazing how these strategies can pinpoint those subtle shifts in the market.
It is pretty cool.
And we've only just scratched the surface.
I know, right?
Kestner goes on to discuss strategies based on moving average confluence, normalized envelopes, adjusted stochastics.
This is so many. It's a whole world out there.
It's a whole world of quantitative possibilities.
It really is a treasure trove of ideas.
And what I appreciate about Kestner's approach is that he doesn't just throw these strategies at you and say, good luck. He emphasizes the importance of testing, understanding their limitation, and knowing when they are likely to work best.
It's a reminder that quantitative trading isn't a one-size-fits-all approach.
Very true.
It's about having a toolbox of strategies and knowing which one to use in a given situation.
Exactly.
Now, in addition to specific strategies, Kestner also talks about broader trading concepts like pyramiding and profit-taking.
Important stuff.
Can you shed some light on those?
Sure. So pyramiding and profit-taking are two approaches to managing your positions once you're already in a trade. Pyramiding involves adding to a winning position as the trade moves in your favor.
So if I buy a stock at $100 and it goes up to $110, I might buy more shares at $110 to increase my exposure to that winning trade. But isn't that risky?
Well,
what if the trend reverses?
It is risky, and that's the trade-off. The idea behind pyramiding is to maximize your profits by increasing your position size as the trend continues. Profit-taking, on the other hand, is about taking some chips off the table
Okay.
as the trade is working in your favor,
Right.
locking in profits and reducing your risk.
So it's a more conservative approach.
It is.
Aiming for steady gains rather than those big home runs.
Exactly. So which approach is better?
Yeah.
That's the million-dollar question, isn't it?
It is.
Kessner actually tested both pyramiding and profit-taking using the channel breakout strategy as a base case, and the results might surprise you.
Okay. You got my attention. Don't leave me hanging.
Well, neither pyramiding nor profit-taking consistently outperformed the standard channel breakout strategy. In fact, in both futures and stock markets, the plain vanilla channel breakout generated better risk-adjusted returns.
So sometimes simpler is better.
It would seem so, at least in this case. It highlights the idea that adding complexity doesn't always translate to better performance.
Right.
Kessner suggests that both pyramiding and profit-taking can introduce complexities that might not be worth the extra effort.
It's a reminder that we shouldn't overthink things.
Sometimes.
Now, you can't talk about quantitative trading without mentioning arbitrage, right?
Oh, yeah, arbitrage.
What does Kessner have to say about that?
Arbitrage, the holy grail of trading. It's the idea of exploiting price discrepancies between different markets or securities.
Right.
Buying something at a lower price in one market and simultaneously selling it at a higher price in another.
So it sounds like risk-free profit.
In theory, yes.
Yeah.
If you can buy something for $10 and sell it for $11 at the same time, you have made a guaranteed dollar.
Yeah.
But in practice, pure arbitrage opportunities are extremely rare and fleeting.
Because as soon as people see that price difference, they'll jump on it and the opportunity will disappear.
Exactly. It's a constant game of cat and mouse.
Yeah.
With traders competing to exploit those tiny inefficiencies.
So what kind of arbitrage opportunities does Kessner actually discuss?
Well, he talks about classic examples like local ADR arbitrage. Which involves exploiting price differences between a company's stock listed on its local exchange and its American depository receipt, or ADR, which is a way for U.S. investors to trade shares of foreign companies.
So it's like buying the cheaper version of the stock and selling the more expensive one. Taking advantage of that discrepancy.
In essence, yes. But there are additional complexities to consider. Such as currency exchange rates and transaction costs. Kessner also talks about stock index arbitrage, which involved exploiting price differences between a stock index futures contract and the prices of the underlying stocks that make up that index.
It sounds like arbitrage. Even the seemingly simple kinds is a very specialized game.
It definitely requires a deep understanding of market mechanics and the ability to execute trades quickly and efficiently. It's not for the casual trader.
Now, on a related note, Kessner also discusses relative value trading.
Yeah.
How does that differ from arbitrage?
Well,
they both seem to be about exploiting price relationships.
You're right. They are similar in that they both involve profiting from price discrepancies. But relative value trading isn't necessarily about locking in a guaranteed profit like pure arbitrage. It's more about betting that those price relationships will revert to a historical mean.
So you're identifying pairs or groups of securities that have historically moved together in a certain way. And when those relationships deviate from the norm, you make a bet that they'll eventually converge back.
Precisely. It's like a mean reversion strategy. But applied to relationships between securities. Kessner explores a range of relative value strategies, including yield curve trading, credit spread trading, and volatility trading.
Wow, so many different ways to look for opportunities in the market.
I know, it's pretty amazing.
Can you give us a quick overview of those strategies?
Of course. So yield curve trading involves exploiting discrepancies in the yields of bonds with different maturities.
The yield curve. That's the line that shows the interest rates for bonds with different time horizons.
That's right. The shape of the yield curve can change over time, creating opportunities for relative value traders to bet on whether the spread between short-term and long-term interest rates will widen or narrow.
Makes sense.
And then there's credit spread trading, which is about exploiting discrepancies in the yields of bonds with different credit ratings.
Okay.
So you might buy a bond issued by a company with a high credit rating and sell a bond issued by a company with a lower credit rating.
Right.
Hoping that the spread between those yields will narrow.
So you're essentially betting on the perceived riskiness of those borrowers, hoping that the market will reevaluate those risks in a way that benefits your trade.
Exactly.
Okay.
And finally, there's volatility trading, which is about betting on the future direction of market volatility.
So I might bet that the market as a whole is going to become more or less volatile in the future?
Precisely.
Okay.
Kestner uses the VIX, a popular measure of market volatility, to illustrate how traders can capitalize on swings in volatility.
We've covered a lot of ground, from channel breakouts to arbitrage to relative value strategies.
There's a lot.
Yeah. It's clear that quantitative trading is an incredibly diverse field.
It is.
With strategies for all kinds of markets and conditions.
It truly is a wide-ranging field.
Yeah.
And what's great about Kestner's book is that he provides specific examples, backtest data, and insights into the challenges and opportunities of each approach.
It's been fascinating to see these strategies in action.
Yeah.
I'm starting to understand why quantitative trading is so appealing to many investors.
It's about having a systematic, data-driven approach to navigating the complexities of the market.
Before we move on to the final part of our deep dive, are there any other key takeaways you'd like to highlight from this exploration of quantitative trading strategies?
I think it's important to remember that even though we've been talking about specific strategies, quantitative trading is ultimately about much more than just following formulas. It's about understanding the principles behind those formulas. Being able to adapt them to changing market conditions. And always managing your risk carefully.
It's about having a framework for thinking about the markets, not just a set of rules.
Well said.
Yeah.
And with that, let's move on to the final part of our journey into the world of quantitative trading.
I'm excited to see what other insights await. Welcome back to the deep dive. We've been exploring this fascinating world of quantitative trading with Lars Kestner's Quantitative Trading Strategies as our guide. We've talked about the philosophy, the psychology, and we've even delved into some specific strategies. What else is there to uncover in this final part?
Well, we're going to go even deeper into some specialized areas of quantitative trading, and we're going to discuss the challenges and opportunities that lie ahead for this ever-evolving field.
Sounds like the perfect way to wrap up this deep dive. Lead the way.
All right, so Kestner dedicates a whole chapter to strategies that are specifically tailored for relative value markets.
Right, relative value.
Remember, these are markets where you're not betting on the direction of a single asset, but rather on the relationship between two or more assets.
Right. We touched on this in the previous parts with examples like yield curve trading and credit spread trading, where you're looking for those discrepancies in yields.
Yeah.
But I'm definitely ready to go deeper. What specific strategies does Kestner highlight?
One that caught my eye is the moving average confluence method.
Confluence, that makes you think of like things coming together. What's converging in this strategy?
So imagine multiple moving averages of varying lengths, all clustering around a specific price level. This convergence suggests a strong support or resistance zone, acting as a potential barrier for the price.
So if the price breaks above that cluster of moving averages, it's like a sign of strength, a potential breakout to the upside.
Right.
And the opposite would signal a breakdown.
Exactly. Kestner tested this strategy across a range of markets, and the results were pretty impressive. In futures markets, for example, the moving average confluence method achieved a Sharpe ratio of 1.30 and a K ratio of 0.31.
Those are solid numbers. It seems like this strategy could be especially powerful in trending markets, where those breakouts from confluence zones could lead to significant moves.
That's a good observation. Kestner also discusses how you can optimize this strategy by adjusting the lengths of those moving averages and the thresholds for entering trades, allowing you to fine-tune it to different market conditions.
Of course, always being mindful of the risks of over-optimization and curve fitting.
Always.
Now, you mentioned another intriguing strategy for relative value markets, the normalized envelope indicator.
Right.
Didn't we talk about envelope indicators in the last part?
We did.
What makes this one normalized?
You have a good memory.
Yeah.
We did talk about envelope indicators.
Yeah.
which are used to identify price extremes away from a moving average.
Right, right.
The normalized envelope indicator takes this concept a step further.
Okay, I'm all ears. How does it go beyond the traditional envelope indicator?
Okay, so traditional envelope indicators use fixed percentages to create those upper and lower bands around a moving average. But the normalized envelope indicator uses the historical distribution of price deviations from the moving average.
So instead of fixed percentages, the envelope is adapting to the market's volatility.
Exactly.
It's dynamic. Does that make it more accurate?
That's the idea. It's more robust and less prone to false signals, especially in volatile markets.
Okay.
The strategy involves setting thresholds for the normalized envelope. For example, you might go long when the price falls below a certain lower envelope, suggesting an oversold condition, and vice versa.
Kessner applies this to ExxonMobil stock, and it seems to be quite effective in identifying turning points in the market.
It does. And in his performance data shows the normalized envelope indicator delivered solid returns across a variety of relative value markets.
No matter how sophisticated the strategy, it all comes back to money management, right?
It does.
Even the best strategy can fail if you don't manage your risk properly.
You got it.
What specific aspects of money management does Kessner emphasize?
Well, he spends a lot of time discussing leverage, using borrowed money to amplify your returns. He actually provides a formula for calculating the optimal leverage for your strategy, taking into account factors like its expected return and volatility.
That makes sense. Leverage can be a powerful tool, but it's also risky. Too much leverage can wipe you out, even if your strategy is sound.
Exactly. It's like driving a car. You can get to your destination faster by speeding, but the risk of an accident also increases.
That's a great analogy. So as we wrap up this deep dive, what are some of the most important things to remember about quantitative trading?
I think first and foremost, remember, it's a data-driven approach. It's about using data to identify patterns, backtest your ideas, and manage your risks systematically. It's not about relying on gut feelings or chasing the latest hot tips.
It's about removing emotion and letting the numbers guide you.
Absolutely. Second, remember, it's not a magic bullet. Quantitative trading requires a deep understanding of statistics, mathematics, and how markets work. It also demands discipline, patience, and a willingness to constantly learn and adapt.
It's not a get-rich-quick scheme, but rather a long-term process that requires effort and dedication.
I agree.
Finally, remember that quantitative trading is constantly evolving. New technologies, new data sources, and new strategies are emerging all the time.
All the time.
That's what makes it so exciting. It's a field with endless possibilities. Lars Kessner's Quantitative Trading Strategies has been a fantastic guide on this journey. What a fascinating exploration of this complex and intriguing world.
It really has been. I think we've given our listeners a lot to think about and explore.
This has been another enlightening deep dive. Thanks for joining us, and remember, keep diving deeper into the world of knowledge.